The stock that I want to talk about, it's going to have some technical. So we're going to go look at some technical patterns, and then we're going to have to pick a strategy because I want us to look at my good old buddy Netflix. So give me a chart on Netflix here, if you will.
You can't leave it ever. Ever.
Can't.
You can't quit Netflix.
We
Ever.
have a relationship,
You do.
it's been long witstanding. This is one of the stocks
Mhm.
that, when we talk about growing up, right? We're like me and you, we're like that Gen X, right?
Yep.
We grew up with Blockbuster. We grew up going to the malls and actually shopping there. We grew up, on MTV and playing out to we're that last generation that did all that stuff,
Like
right?
when MTV actually had music. Yeah.
Yeah, exactly. Nobody, these kids will never understand that. So when
No.
I grew up in the trading and investing world, which has only been about 8 years old, so I'm 8 years old in this whole world.
Going on 18.
Exactly. I came up with the FANG stocks, right? It was Facebook, it was Amazon, Facebook was Facebook, right? This whole meta stuff. It messes with the whole rhythm of the whole thing. Anyway, so I grew up with the FANGs. It was always Facebook, Amazon, Apple, Netflix, and
Microsoft, Google. Yeah.
And we're talking about communications, we're talking about tech, and even then they weren't split up. They were all just kind of under one umbrella, right? But here we are looking at Netflix, and we talked about this earlier. I'm looking at that XLC chart, and I like the breakout. I'm looking at Netflix, and I love the pullback. So let's talk about this technically first.
Yeah.
Then I want to talk about strategies because I want us to have a debate, but more a conversation of theta versus delta.
It's a debate. It's a debate. It's delta v theta. I'm sick of getting steamrolled by you theta dogs over there. No, it's a debate. Delta v theta.
I was trying to give you just a little win, and I call all right. I'm gonna stomp you on this, but
stomp like curb stomp. I love this. Let's go. Let's go. Emily bringing the fire cheat here today.
Theta people can cheat. You guys
they
can.
They can. Theta can cheat.
Wait. Anyway,
Delta's wrong. Hey, tell you what. Little mini trade masters here. Emily's going to take the theta. I'm going to take the delta, and everybody's going to tell us, do you prefer theta or delta here? Okay,
and we'll go. Okay, all right. So let's talk technicals and patterns first. We got a little cup and handle situation happening here.
Yeah, cup and handle.
Draw it for me.
Yeah, the cup and handle technical formation is a really good continuation pattern to where you can look at it in twofold. Number one, you can look at it from a front runner perspective where you have an elevated support level within the neutrality. And that elevated support level within the neutrality is really, really important given the fact that it kind of resets the distance you're running into the breakout. And this is a pet peeve of mine technically. If there's one thing technically I hate more than an overextended breakout, I'm not sure what it is. I cannot stop staring at a stock that runs from 315 all the way to 345 without even a moment of hesitation and saying it's going to continue to do what it's been doing and even more so. I have a really difficult time seeing that. And again, I'm not trying to throw cold water on the momentum analysis. That's a me problem. I just can never overcome that. I just can't. And so I love it when that stock, which is overextended coming into the breakout, gives a little bit of reprieve and comes down just a little bit, and it resets the distance you need to run. See, stocks, they're like people. They're like people, Em. If you and I went outside, it's 95 degrees outside. It's a little bit humid. And if we went out and ran as fast as we could for a mile, I'm willing to bet we would want to get a little bit tired. We want to take a little bit of a break. Stocks, when they run, they get tired.
Technically, I'm Kenyan. I can probably go 3 miles before I have to stop.
This is accurate. I should have known this. I should have known this. I should have known this.
I'm not tribe.
You got the DNA. You and I better not have this conversation here. We'd get in trouble. We'll have that conversation offline. That's the tribes of Kenya conversation that might get me into some hot water.
M's running the same mile Matt is running, so not me.
M's trying to get Matt in trouble here is what's going on. But no, you're running a mile. See, that's my 1 mile. That's Emily's 3 miles. Okay. So running into resistance, getting a little bit overextended, taking a break, and then it resets the distance you got to run. So if you're used to running a mile, and all of a sudden you reset the distance you're running from 318 all the way up to, say, what is that number, right around 332, all of a sudden that same mile puts you up into the 370 level instead of the 350 level. And so it's just a really good pattern within consolidation to reset that distance that you're running into the breakout. And so a cup and handle pattern is a really, it's a compelling pattern for two things. Number one, and why I like this conversation so much on Delta V Theta, is it's a legitimate debate. It's not one of those situations where I'm looking at a breakout in XYZ company and you theta traders are like, oh, just do a theta trade. I'm like, what are we talking about? This is a breakout. It has multiple times. What are we doing? No, buy a call, YOLO, let's go.
No.
No, that's not it. This is a legitimate debate where you got a double top of resistance, you got an increase in support against the double top of resistance. That's an opportunity where you, as a Delta trader, could look at front running the breakout.
And look at those candles, right? Look at the retracement candles. You've got big candle, big candle, small candle on the 9. You got volume decreasing. I mean, it's just perfect. RSI is 60. Just beautiful.
Well,
love it.
And honestly, last night I was talking about the creation of a pivot and the data, the micro data that we look at in creation of a pivot. And one of those things that is really easy to understand in the creation of a pivot is the slowing momentum of candlestick analysis. It's more nuanced and difficult than just a small candle at support, obviously, but that's what we have. We have a small candle, call it a spinner, call it a doji. You got a small candle at a support level, the 90 MA. And so, yeah, you still see this as a downward movement in price, but you see it as a slowing momentum in a downward movement in price. And then you come out to your volume conversation, just to give a little bit of supporting evidence here, Em, just to go to volume here. What does volume tell you in that 3-day pullback as well?
Yep. Slowing momentum. Less sellers than they are buyers.
So, which tells you that the people that were running this up from 17, 18, all the way to 345, it's them just locking in profit. That's all that's happening. That's all that's happening in the last 3 days is you have a decreasing in volume, which is pure. You want to see that decrease in volume. You want to see the trend, the pattern, the bullish retracement or the bull flag we're looking at. You want to see that decrease the same way you want to see volume decrease.
Right.
And so you got that coming in right here, and here as well. So yeah, technically you're looking at a pretty good continuation pattern. You got a lot of supporting evidence here. And then if we get that upward movement in price here, that would confirm this level right here as an increase in support level as well. And so, yeah, it's got a really good technical backdrop to it. And it's not Meta breaking out of an all-time, or not an all-time. Meta's got a lot of work to get to the all-time. It's not Apple breaking out of the all-time. It's not chasing Microsoft's latest breakout. It's not, trying to catch the momentum happening in Amazon and Google. It's got a pretty constructive pattern on Netflix. And then when you come out to the weekly chart here, you just see 350 here as the ultimate breakout. 350 breaks out. Nothing stops until you get into the mid 370s. And then obviously it's a journey to 400 over time. So I think technically here, again, geeking out on a continuation pattern, but that's what we do. We geek out on patterns that have a tendency to win out over time, right? I like the increase in support, backdrop against the cup and handle pattern, got a really clean breakout against 350. And it regards whatever you and I say on strategy. If a trader simply wants to wait for the 350 breakout, nothing here, like no criticism here. That 350 breakout's alive and well. We're just talking about things you can maximize from a strategy perspective while you're waiting on that potential breakout.
Yep. And this is now where the theta versus delta, separation starts to happen, right?
All right. Let's
You
go.
guys have to wait for breakouts and confirmation candles and yada yada yada.
Look at you guys. Look at you guys. You're getting all tribal on me. You guys.
You guys,
Same team.
you guys have to wait. I can sit here and start to build on a bull put, and that's what I want to talk
Yeah.
about today. Is how would I approach this, and how would you approach the delta trade? Okay.
Mhm.
No wrong answer. Anybody, and you can pick either side. It's just, our personal preferences,
Yeah.
right? I'm looking at this and I'm going, okay, when I start to build my bull put spreads, I'm looking at where my support level is. That's the first place I'm looking. Right. I'm looking at that 320 line. I'm going, all right, boom, I've got that. But I'm also going down below, then I'm seeing that 200-day moving average. And I'm thinking, okay, that's another level, right? So depending on how far and where my deltas are going to be, how, bullish I am in the idea of the strategy, all that stuff is going to come into play. But I'm not doing anything underneath until it's underneath that 320, 315 line. Okay. So now if we go to the options chain, if you will, and give me that 31-day. And we talked about that 315, 320 line. I want to look to see what that delta is. That's kind of like how my brain just works. I just start there and just go, okay, what do I? All right.
20. So your first level support that you're comfortable selling under. And I love what you just did there, Em. You looked at support and you said, okay, before you even went to Delta, and this is something that we preach at Tackle Trading. Before you go to Delta and you just randomly select some arbitrary Delta that may or may not have absolutely anything to do with anything, you probably want to check the chart to understand where the buyers are coming in at, so those buyers can help your credit spread. And so I love what you did just there. You said, okay, let me see where support is first. Let me see where that strike price is right under that support to then decide at that point, do I get more conservative here? You're comfortable selling underneath 320. The next strike price is 315. It's got a 28 delta. Continue.
Yep. And so 315 is fine, but that's a 28 delta. My comfort zone when all things are riding great is going to be that 25 or below. We don't have that breakout at 315 yet. I might even go lower than that. So I'm looking at that 300, 295 number there, or even at 305. But anywhere like in that 300, that's where I want to start to see if it's even going to meet my criteria of cash flow, ROI, all that good stuff. Now, if you draw me, or if you just kind of draw me a price slice there on the chart, just so I can see now visually where that line in the sand is for me on the chart.
On the 300?
On the 300, yep.
You're selling right here.
Right there. So now that is now me looking and going, all right, I'm kind of front lining this. I don't have confirmation yet because we don't know that Netflix is done coming down, but based on everything that we've looked at, we've got slowing momentum. It's sitting on the 9. All that stuff is in my favor. But just in case, I want to give myself some cushion, but still pick up some cash flow. So that's gonna be my first that I'm looking at right there. That's where I'm gonna start. Now, if I want to cheat on this a little bit, I could leave it as a bull put spread. Or I could even, if you look at the top side for me and give me that high point, stretch that chart out a little bit more. I could even go iron condor on this and go all the way up to 375, where the all-time high was at one point, and pick up some more premium there as well too. But for now, I'm going to leave it as a bull put. But just for a way for me to pick up a little bit extra cash flow, I could credit spread, iron condor this, and also put up a credit spread on the top side and go above 380 and pick up a nice dollar or so. But for now, I'm just going to leave it here as that's my theta play.
Because you're going to wait for my delta trade to work out and then sell that bear call to maximize the range there.
But of course.
Right. So what Emily just said, guys, is listen, it's a bull put trade. It's 300 to 295. That's your trade. 16 delta. You're getting 63 cents on the credit, $5 on the margin. That roid's going to be perfectly fine. It's a decent credit for the delta you're getting, and you're maximizing your range. That's a really good bull put spread. 30 days out. Now, what Emily said was the strategy is bull put, but after you get that test up. That's what she was referring to. After you get that test up, what she can do is she can come to the options market and say, now let me sell above that resistance level, right? Because as of right now, if you're going to go out that much time frame here, 30 days on the bull put side, and you want to wrap that bear call, you got to wrap that bear call right around 365 right now. Okay.
Mm-hmm.
That 365 is right there. If you wait to get the resistance test, not the breakout here, just the resistance test right around 345, you can all of a sudden sell 380. And so that maximizes your range and it allows you to get above your resistance level. So that's just a technique of basically it's a scaling in approach to an iron condor, and something utilized by credit traders all the time. So I just wanted to explain that a little bit. And that's pure trade. That's a great trade. Like truly, I mean, you identified your support level that you had to sell under. You're in a space that has some bullish positivity right now from a bias perspective, and not just Netflix, but communications in general. You got 84% probability of cash flow and $63 per contract. Your ROID's going to be right around 70%. It's pure. And then you got me on the, hey, we're gonna wait for that technical analysis to play out. We're gonna wait for the bear call by waiting for a resistance test here. I thought it was pure. I thought it was pure. Well done.
All right.
Well done, young lady.
All right, give me your play.
I don't know if I can beat that. I don't know if I can beat that, but I'm going to try.
I have a feeling you might.
I'm going to give it the college effort.
Go ahead, Delta Dog. Go ahead, give me
first and foremost, I already broke down the technical condition, right?
Mm-hmm.
I already broke down the technical condition. This is a front running bull call spread. So one thing that I think is a pretty good technique that can be utilized for both what you were talking about, on the scaling in approach to an iron condor, with the bull put being put out first, waiting for a resistance test to add the bear call. I think you can do a little bit of a similar approach from a directional perspective, but obviously the strategy is going to be different, but a similar mindset from a scaling in perspective. The strategy I want to talk about is a bull call spread, which is the delta version of the vertical credit spread. So you're doing a vertical credit spread. I'm doing a vertical debit spread. You're going to work 30 days out to take full advantage of theta. I'm going to work about 60 days out to mitigate theta, right? Yeah. So the things that benefit you, I need to mitigate because they're a risk to the delta side of the equation. One thing, the standard bull put spread, the standard bull put spread is a 30-day, excuse me, is a 30-day contract. Excuse me. It's a 60-day contract. Let me go down, where you buy an at the money call option. We'll just say 335. You buy an at the money call option and you sell an out of the money call option, where you basically bring your net delta down to about 25. So if you're going to buy a 52 delta contract at the money, you'd probably want to come sell that, 380 contract which has a 24 delta. And so your spread would be 335 by 380. That's your spread. And so you're buying the at the money call option, you're selling an out of the money call option, you're bringing in a little bit of cash flow to offset the cost. And so if the cost of the call option is $23, we're going to bring in about $7.20 to cover some of that cost of the call option, to bring down our cost a little bit. That's the bull call spread. Now, I'm going to modify it just a little bit. I'm going to modify it. And what I'm going to do is, because I expect a resistance test here. I think you do as well, or you would just, or you just would have sold the bear call. Yep. If you did not expect some price appreciation coming into right around 348, 350, you would have just sold the iron condor, and you would have locked down that neutral risk wrap, bring in, cash flow on both sides of the ledger. But you didn't do that. You said, you know what? We're going to wait on that resistance test, and we're going to sell that bear call spread a little bit higher. I'm doing the exact same thing here, Em. I'm not going to initiate at 330, 335. I'm going to initiate at 350. And so the call option that you can buy would be the 350 call option. Now, that puts you right here. at a 42 net delta. Cost would be about $16.30.
All right.
Now, you can just very easily right now, legitimately so, just go buy a bull call spread today and wrap that same conversation trying to get yourself about a 25 delta, right? You can come out to 350, pay 1620, 1625, 1630, 1635, whatever it is, and then come all the way down here and say, let me sell that $400 strike price. Okay, let me sell the $400 strike price, bring in a little bit of cash flow to offset the cost, right? You could easily do that. But what I'm going to say is this. I just like buying the call option. And then as it gets to 350, the same time frame you're going to sell that bear call, I'm going to wrap the call option on that and thus create the bear call spread, which means we're going to sell the exact same strike price there, young lady, and we're going to have some fun. We're just I'm going to be on the call side of the equation. You're going to be on the credit side of the equation. So I like an out of the money bull call spread, front running call option at resistance. As you work into resistance, you wrap the bull call side of the bull call spread. So I like a front running bull call spread on Netflix breakout. Your thoughts, young lady?
I love it. I love it. You found a way to, take advantage of the resistance level as well too. So win-win for either side. I wouldn't have any issue if somebody come and told me they're going to do this exact same thing.
I think they're both really good trades.